Hey, it's Dr. Asatar, and this lecture is about monetary policy. So, modern monetary policy is based on a fiat monetary system, okay, like we've discussed in previous lectures, though the roots of monetary economics are older. Uh, and the fiat monetary system allows monetary policy to have a much greater impact. Okay, a commodity standard, for example, the gold standard, limits how far expansionary monetary policy can go. Okay, so let's look at the relationship between money and economic growth. So the way this works is we have changes in the money supply. Okay, so it's measured by M0. Recall that's the monetary base. M1, M2, or M3. These are different monetary aggregates. They're measures of the money supply. So changes in the money supply lead to changes in little I. Okay, the interest rate. Right? Changes in the interest rate then lead to changes in total investment. All right. Based on the Keynesian theory of investment, the idea that the interest rate represents the opportunity cost of investment. Changes in investment then lead to changes in aggregate demand. That's total spending. And these changes in aggregate demand have two possible effects. Okay, one, uh, the change in GDP, and the other would be a change in the price level. Okay, so this is a more complex causality, a more complex causal chain than what we've dealt with in the past, which is why typically monetary policy, monetary theory is toward the end of the course. All right, so the goal of monetary policy in the Keynesian schema is to stabilize the economy. That is, to smooth the business cycle and to control inflation. Okay, so if the economy is doing this over time, right, we have GDP growth expanding and contracting, in the typical business cycle fashion. The idea is when we are in recessions during these troughs, we should be using expansionary monetary policy, and when we're during an expansion, we should be doing the opposite, right? Doing contractionary monetary policy, and in that way, we will get to a smoother business cycle. We'll go from a more volatile version of the business cycle to a less volatile version, right? Uh, just like we discussed under fiscal policy, same goal there, but this is just using different means. Okay, so a question we have to get at is how does money affect the economy and what determines the value of fiat money? Um, so the thing is, of course, that fiat money does not have an intrinsic value, right? It is not backed by anything. It's non-convertible. There is no set relationship between the numbers on the paper or the numbers on the computer screen or whatever, right? And anything in particular. So in the past, money had value because it was a set weight of some precious metal, gold, silver, copper, etc. Right? Um, but okay, so here's the thing: fiat money still has an opportunity cost, right? In economic theory, opportunity cost is the price or value of anything. Okay, so the opportunity cost of holding money is the value of money in a fiat system. All right, so value of money, opportunity cost. Remember what that means. That means what you give up by holding money, by doing anything, right? It's the next best alternative. So what do you give up by holding money? You give up little I, the interest rate. All right. And what determines that? Well, that is determined by the money market. Okay, so the money market is the supply of money, the money supply, and the money demand. Okay, the demand for money. So let's examine these different forces, this money market. Okay, so if we look at the relationship between interest rates and money, what we find when it comes to the money supply is these two are independent. Okay, in Keynesian theory, the idea here is the money supply is driven by the policies of the central bank. Okay, so that which regulates the fractional reserve system. Okay, and especially the key part of it. Okay, the minimum reserve ratio. Right, that is like the gas and the brakes of the monetary system. So the money supply curve is vertical because these policies are not related to the interest rate. They affect the interest rate, but they are independent of the interest rate. They're not caused by the interest rate. Okay, so changes in central bank policy are going to shift the money supply curve. Okay, so lowering the minimum reserve ratio shifts the curve to the right. All right, that means banks' money creation and the money multiplier are going to be more powerful the lower the reserve ratio is. Okay, raising it, on the other hand, is going to shift the money supply curve to the left. Um, Now, I mentioned this because this is the easiest thing to understand. Again, the reserve ratio, that is the key piece of leverage. That's the thing that allows monetary policy to function at all. Now, in practice, central banks actually use this very, very rarely. They don't actually change the reserve ratio, the minimum reserve ratio, that often, but they can, right? Now, I'm just starting with it because it's the easiest to understand. What they typically do is things that are a little more indirect. Changing the minimum reserve ratio is kind of like stomping on the brakes, right? That's not good for your car. You want to kind of ease your speed down, like ease down on the brake pedal or ease down on the gas pedal. You don't want to floor it, right? Or all right. So uh, what they do much more often is they have this intrabank lending network, right? That is the the banks loaning to one another, okay, for the purposes of reserves. Again, this goes back a long way historically, right? Central banks are hundreds of years old, uh, and they created this network where banks could borrow from each other when they needed to and lend to each other if they were not in need of that, right? Um, a closed market that's only for banks. And as central banks grew in power and prominence, they began to control this market much more carefully, much more closely. Um, and so this intrabank lending market in the United States, the interest rate at which banks borrow from each other is called the federal funds rate. Okay, and again, this is only for banks. Okay, so you cannot, the average person or business or whatever does not have access to this market. Uh, the Fed also has a slightly higher interest rate, which they call, weirdly enough, they call the discount rate. Um, and that's the rate that banks can borrow from the Fed, as a last resort. Okay, so if banks cannot find a lender, there's no banks that want to lend, that happens sometimes. The Fed says, well, we will be there, we'll be the lender of last resort for you. And this is the most common thing that the bank does. This and then the next thing, okay, which is that the Fed can buy or sell treasury bonds from banks' reserve balances. Okay, so and again, this is very common. The second and third one, very very common. Now, just it's important to note that the Fed is not intervening in the overall treasury market, right? The treasury market is large, many different uh, individuals and corporations and many different kinds of parties and institutions hold treasury bonds. This is not what the Fed is doing. The Fed is buying or selling directly from banks' reserve balances. Okay, so it's much more targeted, and by doing that, both of these things affect the reserves that are available to banks for lending. Right, so they're trying to have an influence over lending because that is what really expands or contracts the money supply. Okay, when loans go up, the money supply expands. When loans go down, the money supply contracts. All right, here's a history of the federal funds rate uh, going back to about 1970 or so. Okay, you can see that the federal funds rate was quite a bit higher in the 70s and early 80s. Okay, so this is that period of monetary confusion and chaos that occurs in the United States and the world in general. When the United States, ends the gold standard 1971, you can see there's two recessions that are associated with this. And then this period in the early 80s, a period of high inflation. Okay, so the federal funds rate goes up dramatically, and this is part of Fed policy at the time. And then it moderates after that. Okay, so we get into the 80s, the federal funds rate is much lower. Over the course of the 90s, the federal funds rate, trends downward yet again. Uh, and then we move into a more recent period, and we'll discuss that as we in shortly. Okay. Um, Okay, so the effect of policy on the money supply, okay, that's the next thing we're going to explore here, all right? So expansionary monetary policy would involve lowering the minimum reserve ratio, lowering the interbank lending rate, the federal funds rate, and buying bonds from banks' reserves, which converts the treasury bonds into cash, allowing banks to then loan that, right? You would think that bank reserves is all cash, but not so, right? A substantial amount of it is actually treasury bonds because banks do not want to hold cash in their reserves, right? It's an opportunity cost for them. So by doing these policies, the theory is that you shift the money supply curve to the right. Okay, you actually effectively increase the money supply. All right, and contractionary policies would go the other direction. Okay, that would shift the money supply curve to the left. Okay, so this is just doing the opposite, right? That's raising the minimum reserve ratio, raising the interbank lending rate, or selling bonds to bank reserves, which is trading, cash for bonds for bank reserves, all of which contract loans. So money demand is the desire to hold money balances or to hold assets such as cash rather than in some other form. Okay, so such as a loan or bond or investment that yields a return. Um, and there's three components of money demand according to Keynes. Okay, so these are reasons why you would want to hold money rather than investing it. Right, the reason you want to invest it is so that you get a return, right? Cash doesn't bear any return. Okay, so the first component is called transactions demand, right? Now, what if you need to buy something, right? That's what transactions demand comes from. If you if you invest, then you don't have the money, right? You have changed the form of the asset. You've moved from cash to an investment, uh, and by doing that, you are going to have to give up your liquidity, right? So Keynes says, look, liquidity demand, we'll consider this separate from transactions demand because transactions demand is like, I know I need to buy something, right? So if you have $10,000, right, how much of that are you wanting to hold in cash versus how much of it are you going to invest, right? If you know you need to buy stuff that totals $500, you're like, all right, well, I know I need to leave $500 because that's my transactions demand. Okay, liquidity demand is a little bit different than that. Liquidity demand is, what if something happens where, what if I want to buy something? I can't think of it right now, but I have the option, right? Liquidity means the speed at which an asset can be converted into cash, right? If you have cash, you have the ultimate in liquidity, okay? And that gives you options. You can buy things or invest in things as you see fit, right? If you've already made the investment, you've given up that option, right? You've given up that liquidity. Okay, so Keynes says there's a certain component of money demand which has to do with this liquidity preference, okay, demand for liquidity. And the third aspect of it is risk management, okay? So this is like what they say, right? You put aside money uh, just in case, right? In case of a rainy day or whatever it is. If bad stuff happens, then you have that money available, for whatever purpose, right? So a certain amount of money as cash, right, that protects you from other risks that you may be taking. It's a way of managing risk. So Keynes argues that the money demand curve is inversely related to the interest rate, and that is, as the interest rate rises, people are going to hold less cash, right? They are going to hold less of a balance for transactions. They're going to reduce their liquidity, and they are going to use less cash for risk management. All of these things, the opportunity cost is higher, and so that's like the price of holding money is higher. So here's the money demand curve, right? Saying if there's an inverse relationship, what that means is as the interest rate rises, people have less demand for money. Okay, um, so downward sloping and changes in this, right? These things could change. There could be a change in transactions demand or liquidity preference or risk or whatever. Any change in the component is, of course, going to change the position of the money demand curve. It's going to shift it. Uh, but this isn't really under the control of policymakers. Like that would be something which comes from the overall money demand. Um, and Keynesian economics focuses a lot on what can policymakers do. Okay, so we don't really focus that much on shifts in money demand. Shifts in money supply, however, we're quite interested in, right? So this is what would an increase in the money supply looks like, right? Um, so expansionary monetary policy, increase in the money supply. As the money supply curve shifts to the right, we're going to move along the money demand curve to a new equilibrium that has a lower interest rate. Okay, and you can see here the interest rate goes from 6% down to 4%, and that's going to depend on how steep is this money demand curve. Okay, and so the total money supply moves from 3 trillion to 6 trillion in this example. Okay, let's look at the ideal results for expansionary monetary policy. All right, so what it would look like is an increase in the money supply, which lowers interest rates, which then stimulates investment, increasing aggregate demand along the flat portion of the aggregate supply curve, all the way to potential GDP with no increase in the price level. All right, so again, we're going to see here it is in symbols. Okay, so increase in the money supply, that's over here, right, leading to decrease in interest rates, leading to increase in investment, leading to increase in aggregate demand, leading to increase in GDP, and no change in the price level. Okay, that would be the best, right? Ideal case. Okay, so here is expansionary monetary policy in the effect in the money market. Okay, again, we're seeing this is the same graph we just saw, right? Shifting to the money supply curve to the right here and lowering the interest rate. Okay, so that's the first two part of this. Okay, then the effect on investment here. All right, so you can see what is now happening. We are shifting along this this investment demand curve. Okay, so going from a position here at 6% interest rates, $600 billion in investment occurs. Okay, when we lower the interest rate, we move along this curve to a position where there's now 1,100 billion invested in total. Okay, and this is because at lower interest rates, the opportunity cost of investment is lower, right? Remember, you could loan somebody the money, right? And if you loan somebody the money, you are going to get the interest rate. So the rate of return on whatever investment you're pondering has to be greater than, or at least equal to, right? It's got to be greater than or equal to the interest rate. So if the interest rate goes down, it's like, well, you don't need a great idea. You don't need some kind of home run investment idea. A so-so idea will do, a mediocre idea. A below average idea will do at low interest rates, right? At high interest rates, you better have a superstar idea, right? So low interest rates, no, the mediocre idea is okay. And there's a lot more of those, right? There's more mediocre ideas out there. So that is why the investment moves up, okay, in response to a decrease in interest rates. Now remember, investment is a component of aggregate demand. So if we shift up investment, even though it's a small component, remember there's a multiplier effect. Okay, so if we increase investment, we're going to increase aggregate demand, and that's going to cause that curve to shift. Okay, so a shift in aggregate demand, assuming the aggregate supply curve doesn't shift, right, stays constant, and assuming that we're shifting here along the flat portion of it. Okay, we move from an initial equilibrium point here at 5 trillion and at a price level of 100 to our new equilibrium here at 12 trillion and still at a price level of 100. And 12 trillion is where the aggregate supply curve becomes vertical. And that corresponds with the potential GDP, or what Keynes calls full employment GDP. All right? That's the ideal case of expansionary monetary policy. However, life often presents us with more mixed results, right? That it's not always ideal, okay? So mixed results occur if the aggregate demand increases along the upward sloping portion of the aggregate supply curve. GDP will increase now, but so will the price level, okay? So our money market graph here is the same. The effect on investment is the same, but notice what's different is instead of moving along the flat portion, we're moving along the upward sloping portion, okay? So we go from 5 trillion, we get growth here, right? The GDP increases, getting close to its potential. But the other thing that increases is the price level, okay? So we also get some inflation, and that's just a trade-off, right? That's life, right? You don't often get the perfect thing to happen Usually it's kind of a mix, okay? So that's expansionary monetary policy with mixed results. All right, contractionary monetary policy, again, has an ideal set of results. Ideal results for contractionary monetary policy would be a decrease in the money supply, which raises interest rates, which lowers investment, which decreases aggregate demand, but along the vertical portion of the aggregate supply curve, reducing the price level, and we will call this fighting inflation, but not changing GDP, which remains at its potential level, aka full employment. Okay, so in terms of symbols, right, decrease in the money supply, leading to increase in the interest rate, leading to decrease in investment, leading to decrease in aggregate demand, which leads only to a decrease in the price level, no change in GDP. All right, let's look at our graphs. Okay, so in terms of the money market, look at what we have. This is just moving the opposite direction. Okay, so we go from MS1 to MS2. We have enacted the reverse kinds of policies, contractionary monetary policy, and the result of that is to increase interest rates. Okay, it begins with the policy change, right? That is, we change the minimum reserve ratio, or we increase the interbank lending rate, etc. Okay, by doing that, we are shifting the money supply curve to the left and raising interest rates. Okay, and the effect on investment is we're going to be moving along the investment demand curve. We're going to be going from 1100 down to 600. Why would we want to do this? Why do we want to hurt investment? Don't we know that is going to then lower aggregate demand? Yes, we do, right? Isn't that going to be bad? Isn't lowering total spending bad? Well, it depends, right? It depends. Are we already at our potential level of GDP? Are we already at full employment, right? So the way we've drawn this, and again, this would be the ideal situation, AD1, we are at our full employment level. See how we're in this vertical portion of the aggregate supply curve. So to reduce aggregate demand, as long as we stay within this vertical section, as long as we don't go too far, we don't want to go over to here, as long as we stay in this range, we can then reduce the price level. And that's what we mean by combating inflation or fighting inflation. Okay, it means reducing the price level. Now, this is a little bit dodgy because usually what we mean by, strictly speaking, reductions in the price level are deflation, right? That's not fighting inflation exactly. So you have to think about it in a different way. You have to think about it as, let's say that the price level had just gone up. It used to be 100, it went up to 130, and we're just bringing it back to where it was, okay? That's still not great because that would be inflation followed by deflation. But this is the best way that the graphs can reflect it, okay? So you just have to kind of keep it in mind, right? This is a simplification here, right? We're doing an introductory kind of model. All right, so, and of course in real life, contractionary monetary policy often offers mixed results, all right? And this happens if the aggregate demand decreases along the upward sloping portion of the aggregate supply curve, right? Then the policy will reduce the price level, that's our goal, but GDP will also fall. So that's more of a trade-off again, right? If we're in the upward sloping region, again, a reduction in aggregate demand causes a fall in the price level, but it also causes a fall in GDP. That's not good. All right, so the Federal Reserve has what it calls a dual mandate, okay? That is, number one, to maintain full employment. And what that means is to engage in expansionary monetary policy when GDP is below the full employment level, all right? And also, number two, to maintain a stable price level, okay? What they mean by that, they're now being rather explicit about that. They're saying to keep inflation low to moderate, around 2%, by using contractionary monetary policy to fight inflation, okay, in the manner that we've described. And so the Fed becomes worried whenever the economy starts expanding too rapidly. They start to worry and they publicly say, well, we're concerned because there may be inflationary pressures right now. All right. Now, the Fed is got a very primary concern, okay, which is to prevent bank failure, right? That is, really job one of the Fed, right? Preventing bank failure. And that's in line with the history of central banking more generally. The idea that central banks should maintain full employment and fight inflation is a relatively recent development in the history of central banking. It's about maybe 80 or 100 years old or so. Okay, it takes place with the rise of Keynesian theory. All right, let's look at some of the criticisms of the Federal Reserve that have been given over the years. And these are also criticisms of Keynesian theory of monetary policy to some extent. Okay, so now just keep in mind the Federal Reserve is a very, very important institution in the modern economy. And so it has its share of supporters and it has its share of critics, right? Not all of the critics agree with each other, right? Not all the supporters agree with each other either. There's a tremendous amount of what you could call armchair quarterbacking of the Fed. That is criticism that is basically saying, I can do better, right? Or it could be done better than what you guys are doing, right? So, but this is not exactly what we're talking about, right? When I say criticisms, I'm not talking about armchair quarterbacking. I'm talking about criticisms of the Fed's function on a deeper level, okay? Um, or the structure or functioning of the Fed. All right, so one criticism says, look, the Fed is the only government agency that's a private corporation. And it's literally owned by those it's supposed to regulate. That's very, very unusual, right? Other government agencies are not like that. First of all, they're not private. The Fed's a corporation, right? That's very strange, right? Um, Even the leadership of the Fed, which is called the Board of Governors, right? And you have the chair of the Fed, the chair of the Board of Governors, is appointed to long terms rather than being elected. And you know what the Fed says is they're supposed to be independent of politics, so that it can make the best decisions regardless of the will of the people. But you know that's a very undemocratic type of argument, right? So that's what this criticism is basically saying. The Fed is an extremely undemocratic institution, and you know if we believed in that as a rule, I mean, wouldn't we want to apply that argument to lots of others? I mean, like you know why should the president or the Congress or the Senate or whoever, right? Why should they be elected? Why shouldn't they be appointed? Shouldn't we get people who are really good at doing their job? But that's not what we do, right? That's because that's not a democracy. So the question here is, whose interests does the Fed really serve? Who does it answer to, right? Um, Okay, and one of the influential people who has made this argument is a guy named William Grider. Okay, and William Grider wrote a book called Secrets of the Temple: How the Federal Reserve Runs the Country. It's a 1989 book. Um, and here, this is an article by him, Why the Federal Reserve Needs an Overhaul. Undemocratic. All right, next criticism has to do with this trade-off between inflation and unemployment. Okay, so this trade-off is called the Phillips curve. Okay, the Phillips curve is an empirical relationship that macroeconomists noticed. It doesn't have much theoretical justification. Honestly, it doesn't come from Keynes. It comes from where Keynesian economics went later. Okay, so in the 1960s is when the Phillips curve relationship first came out, right? So the way this works is like this, right? It says, you know, there's different options in the economy, okay? The economy could choose an option like point A, in which we have a low inflation, but that's going to mean we're going to have a high unemployment rate, right? Um, or we could choose B, where we have slightly higher inflation, we have a lower unemployment rate, or we could have really low unemployment, 3%, and have much higher inflation, right? The Phillips curve says there's an inverse relationship between these. And this means, again, there's kind of a trade-off, right? We can't have it both ways. We can't have low inflation and low unemployment. That's what the Phillips curve is basically arguing. And so critics in this vein say the Fed is just too focused on inflation. They don't care enough about low unemployment. And that's because they're all wealthy bankers, right? They have any of them ever really even experienced unemployment? I mean, it's got to be a very abstract notion, right? If you have never experienced it. You know, you're naturally going to be focused on policies which are a greater benefit to bankers and investors. That's the people that you know, right? That's you, right? That's your experience. You don't come out of the working class. You're probably gonna enact policies which are harmful to the working class. Okay, so criticism here is to sum up. The Fed is a lot more concerned about inflation than it is about full employment. Okay. Um, all right. The next criticism is that the Fed is a very secretive organization. It has never been audited. So, similar to the criticism that says it's undemocratic, this just says, look, the Fed is not very transparent at all. It's in fact incredibly opaque. So, Grider argues this in Secrets of the Temple, and others do, right? Ron Paul is known for making this argument in a 2009 book called End the Fed. And his son, Rand Paul, who's currently a senator as of this recording, has introduced a bill to Congress, which is called Audit the Fed. It's been introduced several times. Each time it's died in the Senate. Um, the criticism here is that there's no outside authority that ensures that its reported cash flows and its assets are accurate, right? Even though these assets are often in the trillions of dollars. Um, that's kind of a problem, right? Other government agencies don't have that, right? Other government agencies are audited by a government agency called the GAO. That's the Government Accountability Office. That's the federal government's accountants, right? So they go ahead and make sure that other agencies are, accurately reporting what they do, right? That's important, right? That's an aspect of all modern corporations, right? All publicly traded corporations are forced to do this because, of course, there's a benefit to being dishonest, right? I mean, you could potentially do things outside of the public's notice, which isn't good, right? That democracy and transparency go together, right? So, and the critics here note that beneficiaries of the Fed's money creation are often very large corporations like Goldman Sachs, for example. So the Fed purchased over $0.7 trillion in mortgage-backed securities from Goldman Sachs. That's $700 billion, right? Out of the total of $1.7 trillion that they ultimately purchased. That's a huge portion, right? That came from one large investment bank. Goldman Sachs is the king of Wall Street here. So, should we not have a better understanding of what the Fed is doing? Should we not have more transparency? That's what these critics are focusing on. Okay, so this is what the Fed reports of its assets. Okay, so this comes from the Federal Reserve website. You can see here, right, federalreserve.gov. Okay, that's where this data comes from. And we can see that in 2008, okay, before the financial crisis hit, the total assets of the Fed were about 0.87 trillion, okay, so 870 billion. Now, as the financial panic occurred and the Fed began a massive spending spree, and they took their assets, they bought a huge number, like I mentioned, $1.7 trillion in mortgage-backed securities. They bought treasury bonds. They bought all kinds of assets, right? So their assets went up massively, right, to $4.5 trillion, where they stayed from about 2014 to 2018. Okay, so they said we'll sell these assets when it is not going to affect the public because we will buy them and then we will sell these assets, and then investors will buy them and so forth. That didn't happen, right? They bought these assets and held on to them. They began to sell them slowly, right? Because the problem is if you are trying to sell trillions of dollars of assets, you're going to reduce these asset prices, and this is the very thing that the Fed is trying to avoid. They're trying to prop up the asset prices, right? Not reduce them. So they begin to sell rather slowly as the market is doing very well, right? Stock market is reaching record highs, beginning in 2018. And so they start to reduce this, but of course, then the stock market begins to falter, right? And then the COVID-19 crisis happens, and the Fed immediately increases their buying, which what this represents is money that's created completely out of thin air, right? When the Fed buys financial assets, mortgage-backed securities, or whatever they buy, the recent one is commercial paper. they write a check, and that money appears out of thin air to back the check, right? I mean, that's amazing, right? How does this work? It's like magic, right? And so we can see that the Fed increased their balance sheet by about $2 trillion in response to the COVID-19 pandemic, and that's as of May 2020. We'll see what they do moving forward. Okay, so another criticism says the Fed, like all central banks, was created to prevent bank failure, right? So, like I mentioned, its manner of doing so, its manner of preventing failure, is to create money in response to a banking crisis. Okay, just like I've been showing you, right? This creates moral hazard. Okay, by protecting banks from risk, the Fed encourages banks to take on, of course, more risk. Right? Larger banks usually benefit more than smaller banks, leading to a situation where we have a lot of centralization in U.S. banking. Okay, the largest six banks control over 42% of U.S. deposits, making them too big to fail. All right. Now, this is something that the first couple of criticisms usually come from the left, right? Saying the Fed is not democratic, or the Fed cares more about inflation than unemployment. These start to be criticisms which come more from the right. Okay, so the Fed has many different critics, right? It's not just the left, it's not just the right. Okay, so some of the critics that I mentioned are Republicans, including this one, right? The Sheila Bair, no relation, is a former chair of the FDIC. Okay, so she's a banking insider. FDIC stands for the Federal Depositors Insurance Corporation. This is another regulatory banking that regulates banks. Okay, so what her argument is in this book is that there's a lot of centralization of banking that occurs because of Fed policy, and this is not good, right? This is not good for Wall Street. It's not good for Main Street. The larger banks have a lot more power. They have too much power. Okay, um, and the idea here is that the ultimate bearer of the risk is not the bank itself, right? And it's not even the Fed. It's the entire society. Okay, the money creation becomes inflation, and we get powerful mega banks. That's essentially the criticism here. Okay, the Fed creates moral hazard by protecting banks from risk. Um, and just to illustrate my point about large banks, okay, so this is U.S. banks by share of domestic deposits from 2019. And we can see we've got three mega banks here: Bank of America, J.P. Morgan Chase, and Wells Fargo. Not far behind there, we have Citibank, Truist Bank, U.S. Bank, and PNC Bank. And so these six banks, 42%, a little over 42% of U.S. deposits. That's a lot of concentration. Okay, another criticism says by preventing bank failures, the Fed is really propping up an insolvent banking system that has a continual risk of collapse. And that creates systemic risk for the economy. Okay, there is no other business or industry that is capable of putting the entire economy at risk. Um, why on earth do we allow that, right? I mean, why create, this is the financial architecture of the economy. Why on earth would we not want it to be as solid as possible? By basing it upon insolvency, we are building our financial structure on a swamp, right? We shouldn't do that. We should be abolishing the fractional reserve system, not supporting it, not propping it up. Okay, this is a much deeper criticism of the Fed, right? It essentially saying the Fed should not really exist, right? And again, we find this coming from Ron Paul and Louis Lehrman. They wrote a book called The Case for Gold, a minority report of the U.S. Gold Commission, 1982. And Murray Rothbard wrote a book called The Mystery of Banking. Um, so the idea here is, the Fed props the banking system up that puts the economy at risk, and we, just should not do that. Okay, the final criticism here, again, a much deeper criticism, is that the monetary policy itself is ineffective. Okay, um, the best known economist to criticize Keynesian monetary policy is Milton Friedman. He's known as the founder of monetarism. But we also could mention the Austrian school. So that is begins with some Austrian economists, von Mises, Hayek, Rothbard, Paul, who I already mentioned. These are all critics of monetary policy and basically argue that it just does not work. Okay, that the argument is monetary policy is ineffective at regulating the business cycle. Okay, money creation and destruction by banks is simply too powerful to be meaningfully altered by the central bank. All right, this is like saying, look, banks can be influenced by the central bank, but they can also overwhelm what the central bank is doing. Like if you if you throw a stone into a pond, you're going to cause ripples, right? But let's say you throw a stone into a the ocean or something like that, right? When there's a tidal wave approaching, you're not going to cause ripples, right? The massive tidal wave is going to swamp the action of, even if you throw in a large stone, it doesn't matter, right? It's going to be swamped by that tidal wave, right? So this is what the argument is, right? The forces here, money creation and destruction, is just much more powerful than whatever the Fed does, okay? So Friedman makes the argument that the Fed should not be trying to do activist monetary policy. They really shouldn't. And what he means by this is they really shouldn't be doing monetary policy at all. They shouldn't. Counter-cyclical monetary policy doesn't work. Okay, that's his argument. The Fed should follow a very simple rule. They should, let's say, just keep inflation at 2%. They shouldn't be trying to manage the business cycle. That's the whole root of the problem. Okay, and Rothbard and Paul and others follow this, right, and say the Fed should just be abolished, right? So Rothbard wrote a book called The Case Against the Fed. And Friedman and his famous book that he wrote with Anna Schwartz is called A Monetary History of the United States. Okay, so very, very influential criticisms of the Fed. Again, probably monetarism is more influential, I would say, than the Austrian school, right? But all of these are important in terms of criticism of the Fed. All right, so let's look at some recent history, okay, and see, uh, does this make sense? Let's try to illustrate this, okay. So let's look at, for example, the real estate bubble that occurs from 2001 to 2007. All right, this occurs during a big economic boom. Okay, we have low unemployment, we have record highs in the stock market, and we have a rapid increase in home prices. Okay. Uh, and this corresponds with an increase in consumer debt, which is across the board, right? That increase in debt is also corporations, government debt. Um, Now, this does stimulate aggregate demand, right? Aggregate demand goes up because, debt raises aggregate demand, right? Debt raises spending. De- Debt facilitates spending that otherwise would not be able to occur. Now, the Fed monitors the economy very closely. They are reacting to the threat of inflation. And what they did was, textbook Keynesian monetary policy. They raised the interbank lending rate fairly aggressively, okay? And they raised it a good amount, right? However, banks used loopholes in the system. Some of these loopholes are called euro dollars and repurchase agreements. Um, so I'll just briefly say what these are. Okay, euro dollars means the dollar assets of U.S. banks that are held in other countries. Okay, it doesn't have to be Europe; it could be anywhere else in the world. Um, Now, the thing about euro dollars is euro dollars are actually not subject to the minimum reserve ratio. Okay, so that's like saying, all right, wow, this is a loophole, right? Because notice that we have these mega banks, right? Um, they operate, some of them operate all over the world, right? Um, so by holding assets in another country, then you don't have the minimum reserve ratio. Wow, okay. What does that mean? Like we truck a bunch of money to Mexico or something? That's not even necessary, right? Because most of the money, like I talked about in a previous lecture, most of the money is intangible. It's it's data. It's a very small proportion of the total money supply. Okay, if we use the broadest notion of the money supply, it's about 18 or 19 trillion dollars. Only about 1.2 trillion of that represents actual printed paper money. Okay, so almost all of it is data that is in your, what's in your checking account, your savings account. Okay, so where is that data located? answer, where is any data located, right? It's written down on it's on a computer, but not just one computer, a computer that communicates with other computers, right? It's in the cloud. So how easy is it to locate that notionally in another country? Very, very easy, right? That's basically an accounting device, okay? So if you wanted to get around the minimum reserve ratio, you could, right? That's a very, very easy for banks to do. They're well aware of that. Regulators are also well aware of it, right? That banks can get around it, okay? Um, Another tactic is to do repurchase agreements. A repurchase agreement is a way of bundling up assets and then making a deal to repurchase those assets, usually the next day, okay? So repurchase agreements also offer you a loophole, okay? You have to pay interest on this, but you do that because you have another investment in mind. Maybe you want to make a loan or whatever it is, which is greater than what you pay in interest to whoever purchased those assets. Okay, so these are ways of evading the minimum reserve requirements. And during this period, what we saw is that money creation continued despite the contractionary monetary policy. Okay, so like I said, the banks follow what the Fed does if they want to, right? It's kind of like, the Fed doesn't control the money supply, okay? Banks control that in a decentralized fashion. Each bank creates and destroys money. It's a very decentralized system. Even though we have a central bank, banks can still go around what the Fed is doing. Okay, so here's what's happening with the federal funds rate. Okay, so like I mentioned, um, the federal funds rate goes from a very low level. Okay, so there had been a recession in 2001, right? So the Fed took the federal funds rate and lowered it in response to that. Okay, and they ultimately lowered it to 1%, which was seen as like very controversial, very low level, right? It's the lowest level that we've seen in recent history. When I showed you the whole history of this going back to 1970, there's no other period where the federal funds rate is that low, right? Most of the time, it's much much higher, right? And it stays at that level for just about a solid year, almost a whole year. Okay, that's this portion right in here. Now, the Fed begins to get concerned in 2004. Okay, and they begin to raise rates. Okay, they see that the housing market is increasing quite a bit. They start to do contractionary monetary policy. Okay, and they take the federal funds rate from its low level of 1% to 5.25%, right? 5.25% by 2006. Okay, so they take pretty decisive action here, right? That's a big increase in the federal funds rate, especially when you think about it as a proportion, right? So they double the federal funds rate. That means going from 1% to 2%, and then double that again, right? But here's the thing, okay? The contractionary monetary policy that they uh, did not reduce the money supply. Wow, how did that work, right? Well, let's look at what bank reserves are doing, okay? Bank reserve, this is a chart of bank reserves, okay? So the total reserves of depository institutions, okay? So what we can see here is that bank reserves were at a much higher level, they fell, and then they started to kind of trend upwards. But this graph doesn't go to zero, okay? So the range of this graph, the range of this data is from about so 37.5 or so, and most of the action occurs between that and 52, right? So 37 to 52 is kind of the range, and that's in billions of dollars, okay? So bank reserves are not changing very much, right, during this period. Um, Even though the federal funds rate is going up dramatically, see, it's not having much of an impact. In fact, bank reserves are actually falling, right? There's some volatility, but see how this trend line is kind of down, right? It's not hugely different, right? At its peak, it's only about 51 or so, and at its low point right here, um, it's still above 40. Okay, so we get to here, and we're at about 43. All right, so okay, that's a bit of a puzzle, right? I mean, the contractionary monetary policy is supposed to contract the money supply. Um, doesn't seem to be doing that. Um, well, what if we look at total demand deposits? Is there any contraction that we can tell going on there, right? Well, the money supply, M2, okay, M2, remember that is checking plus savings accounts, okay? So this is called demand deposits, all right? Meaning, you could withdraw it at any time, right? Demand deposits, that rose, right? There's no monetary contraction going on here, okay? Um, so the total of it by the end of 2007 is $7,468 billion, right? That is $7.46 trillion, okay? And bank reserves are at 43.46 billion. Um, that's a pretty low reserve ratio, right? If we put reserves over deposits, we get a reserve ratio, an effective reserve ratio of 0.0058. Wow, that's very low, right? I mean, what isn't the law that says it has to be zero point 0.1? What happened to that? Well, banks can get around it, right? What this means is just so we're all on the same page. It means for every $100 in deposits, banks hold just 58 cents in reserves, right? 58 cents for $100. Not much money, right? Banks are able to use these loopholes that I mentioned, right? They do that to evade the minimum reserve requirements so that even though deposits grew by 43% during this period, reserves actually fell, right? It seems like the Fed is not doing a very good job contracting the money supply, if that is even their true goal, right? So despite rapid, large increases in the federal funds rate, there's no contraction in the money supply. And we know this from looking at bank loans as well, right? What happens is, the largest loan that the average person ever gets from a bank is a mortgage. And during this period, mortgages are like white hot, right? Mortgages are going crazy. And this is part of what stimulates the housing market is it becomes very, very easy to get a mortgage, even a huge mortgage, way, way out of line with historical values. The historical relationship between mortgages and a person's income is you'd never loan somebody more than maybe triple their income. Okay, so somebody comes in with $60,000 in income, they can buy $180,000 house or get $180,000 mortgage. Um, but that goes out the window, right? Lending goes crazy during this period, okay, especially towards the end of this period in 2007. So we know there is not actually a contraction in the money supply. Okay, we know that from looking at the aggregate data, and we know that anecdotally as well. Um, okay, so what happens next, right? What happens next is this all comes to an abrupt end in 2008. Okay, because 2008 there's a financial panic, right? Um, the real estate bubble begins to burst. The financial panic begins to get triggered, right? At first there's a big increase in stock market volatility. Okay, and then there's a decrease in stock prices, and a pretty big one, okay? The decrease is about 50% from its peak in 2007 to its trough in 2009. Uh, and after that point, the market begins to recover. But, this is a big decrease, right? There's also a rapid decrease in home prices and a rapid increase in foreclosures. And this places a lot of pressure on the MBS market, okay? That's the mortgage backed securities market. So this is a change to mortgage lending. It's part of what made mortgages so easy to get during this period. This is called securitization. Okay, it means taking the mortgage assets that banks had. Right, banks consider their debts to be an asset. Okay, so if they write a mortgage, that is considered on their books to be an asset. Right, it means there's an income stream attached to that. Okay, so the thinking of some Wall Street genius was, what if we take that income stream and treat it like a corporation and sell shares to it? Okay, that's what a mortgage-backed security is. Okay, it's shares of that income stream, but it's based on that there'd be a very low foreclosure rate. Okay, that changes dramatically in 2008, and foreclosures go through the roof. So nobody wants mortgage-backed securities. Mortgage-backed securities are a garbage asset at this point. And the Fed takes very, very swift action here, right? They see that there's a financial panic going on. They quickly lower the federal funds rate basically to zero, right? It can't actually be zero, but it can be 0.25%. That's as low as it can really be. They do that instantly. right? Well, not instantly, but they do it quickly, okay? And they also engage in a set of very non-traditional actions. They create trillions of dollars of new money and inject it into banks and financial markets. Um, and let's look at what happens. Okay, so here's the Fed reducing the federal funds rate, right? Like I mentioned, goes from its 5.25, right, where it was, to 0.25%, and they do this pretty quickly, right? Look at how quickly this decreases, right? Um, and the Fed leaves this at this rate for wow, an unprecedented amount of time. This is as low as we've ever seen the federal funds rate be for this long, right? I mean, 6.5 years. Wow, right? Basically, the federal funds rate is at zero during this period, right? So keep in mind that historical graph I showed you, it's typically a lot higher than that, right? Now, they also embark on a very ambitious program of money creation, which they call quantitative easing. And again, that adds nearly $4 trillion in new money to the economy. That is highly expansionary, okay? So, right, remember I showed you guys this graph already, but just to refresh your memory, okay? We go from the Fed's balance sheet of 8.87 trillion to over 4.5 trillion, right? Creating trillions of dollars in new money is about as expansionary as monetary policy can get. Okay, so the Fed moved everything in the correct direction according to Keynesian policy, right? They vigorously and quickly acted, okay, and they did so in an unprecedented manner. They lowered rates as far as they could possibly go, and then they did stuff on top of that, right? They created trillions of dollars in new money to purchase these financial assets, including mortgage-backed securities, which had no buyers at the time. It was unbelievable, right? Almost every financial asset always has a buyer. It just depends on what the price is, right? If there aren't enough buyers, the price falls. The mortgage-backed securities market at the time was in free fall. Like there was no buyers whatsoever. Nobody knew what they were worth. The assumption of the market in a situation like that is that it's worth zero. So the Fed swooped in and rescued everybody, right? They said, whatever garbage asset you have, we will purchase it as if it's gold, right? Garbage mortgage-backed securities that are much higher risk than you thought, we'll buy them, right? So it allowed anybody who invested in this, not anybody, right? It allowed the big institutional investors, the Goldman Sachs of the world, to get rid of these assets at a very good price, right? It's essentially giving them free money, right? And billions of dollars, hundreds of billions of dollars. Unbelievable. Okay, so all of this expansionary monetary policy, here's the question, right? Did it work in a macroeconomic sense? We know it worked for Goldman Sachs. It worked for it worked for Wall Street. It worked for these big corporations. They got a lot of free money. I mean, a huge amount of free money, right? But did it work macroeconomically? Um, And the answer is no. It did not work at all, right? Banks counteracted Fed policy by shifting their reserves. They decided to hold massive excess reserves. Uh, that's new. We had never seen banks do this before. Okay, very, very unusual. So remember, I showed you before where bank reserves were at before the crisis. They're at 43 billion, which doesn't even register on this graph, right? Because it's so low. Now, by the way, this scale of this graph's a little bit strange, okay, because it's in millions of dollars. So, it's a little hard to parse here, right? But $400,000 million corresponds to $400 billion, okay? 1.2 million. Oh my God, what the hell is that, right? That is 1.2 trillion. Okay, so what happens is reserves go from essentially zero all the way up to $2.8 trillion at their peak. Wow, right? And notice that they continue to go up, right? The Great Recession officially ends in mid 2009. Okay, but banks see that's not really true, right? Like, do banks think it's over? Do banks think the risk is fine? Let's go back to how things were in 2007. They clearly don't, right? Because by 2011, look at this, right? By 2011, they're holding double the reserves that they were in 2009, right? Do bank thinks the risk has passed? No, they do not, right? Based on their reserve behavior, they think there's a lot of risk, right? So, and that continues, right? Even look at this. In 2013, 2014, banks increased their holdings even more, right? They increased their holdings by another 50%. That's huge, right? Now, this is massively contractionary. Okay, this is the Fed has a contractionary tidal wave, right? And I'm sorry, banks are doing this, right? Banks have a contractionary tidal wave. The Fed is throwing a handful of sand at that tidal wave. Which is going to win, right? The banks obviously win here. They do it in a decentralized fashion, right? Even though rates are much lower, banks don't do more lending; they do less lending. Okay, so excess reserves is only part of the story. Like what's happening, this what this means is how do they get these? How do they do this? They don't loan. Okay, and we know this anecdotally. What happens in 2008 and 2009 is that all loans basically come to a halt. Um, and that is very, very difficult for the economy, right? Because most investment is financed, right? Most investment is borrowed. And a tremendous amount of consumer spending is also borrowed. So when banks stop lending and pile up this excess reserves, right? Notice how quickly this happens. That we go from 43 billion to 800 billion just in 2008, right? The end of 2008. And this is why the unemployment rate doubles in such a short period of time here, right? Because you don't businesses cannot afford to invest. They can't finance it, right? They don't have the money right now and they can't borrow it. And so unemployment increases. So these trillions of dollars in excess reserves that the bank's holding, they hold this for 10 solid years, right? It leads to the worst recession since the 1930s. And again, if you just look at banks' actions, you would say, well, this actually still hasn't ended. I mean, the reserve holdings are lower, but they're still 1.7 trillion, right? And now we're in another crisis, as of this recording, right? May 2020. Uh, Banks' reserves never got back to their so-called ordinary level, right? Um, all right, so despite massive expansionary monetary policy, there was still a contraction in the money supply, right? I think, the critics are onto something here, right? Monetary policy is probably a lot less effective than it appears, right? So that is, recent history seems to validate the points made by some of the critics of central banking. Okay, monetary policy may be effective some of the time, but it certainly is not the panacea that its supporters claim it to be. And it's worth asking the question whether the central banks of the world aren't doing more harm than good, right? They're assisting a massive centralization of banking. They're giving hundreds of billions of dollars to huge corporations. So I mentioned that the Fed's main goal, I think arguably their number one goal, is to prevent bank failures, right? I say this because they do not do a good job of maintaining full employment. They also don't do a good job of fighting inflation, right? The Fed props up a system that is inflationary by its very nature. Well, are they able to prevent bank failures? And the answer there is no, they actually are not able to prevent bank failures either. Okay, so here's a map of bank failures, and this is just since 2007. Okay, so look at this. These are all of the banks that have failed. Okay, and this is their assets. Okay, so here's banks that have failed that are in the 6.3 million to 1.5 billion. Those are the small ones. Okay, there's a lot of small dots, right? Some of these banks have $1.5 billion in assets, right? What about the larger dots? Okay, the larger dots have between 1.5 and 6.1 billion. Okay, the big ones have between 32 and 307 billion dollars in assets, right? Some of these bank failures are big bank failures, right? Again, where does the money come from to deal with these bank failures? Well, it comes out of thin air, right? And that is why we say the system is inflationary by its nature, right? Any threat to it, it's an insolvent system. Any threat to it is dealt with by money creation. That's the only ammunition the Fed really has, right? Um, Money creation. Well, what does money creation do? Money creation causes inflation. This is why inflation is a chronic condition in the modern economy. It's gone from being episodic, right? Before central banking, there was historical episodes of inflation, but now it's chronic. Now it's every year, right? There's always inflation. Inflation is like gravity, right? Why is that? Well, it's because we have central banks and we have this monetary policy, which is just basically money creation, in an unpredictable fashion, right? Whenever banks need it. All right, so that's my lecture on monetary policy. Thank you very much.